Hello, welcome to another live episode of Be the Boss of Your Money. My name is Mitch Goldberg. I am a financial advisor with over 3 decades of experience, and I'm with a wealth management firm called Client First Strategy. Is the stock market up too much? Are individual stocks up too much? I'm thinking in terms of stocks that have truly gone parabolic, like Tesla, like Zoom Video, and the names that you're even more familiar with, like Microsoft, Amazon. It is just dramatic what these stocks have done. There are now over four companies that have $1 trillion plus valuation to in the $1.5 trillion range. So we need to talk about this because everybody is relying on the same handful of stocks in order to get the most return that they can. And if everybody's relying on the same stocks, including index investors and active managers, maybe these stocks are too overowned, too crowded, and it's time to be a bit of a contrarian and start to look at other ideas. So let's roll the introduction. We're going to get into this right now, and it's really important. You're going to want to stick around for this. And we're back. Thank you very much for joining me. I'm Mitch Goldberg. We are talking about stocks like Tesla, Amazon, Zoom Video, Google, Microsoft, you name it. Are stocks up too much? That is I don't know, I guess that's a $64 trillion question. Because if you take a look at Amazon, for example, which is up 65% just this year, and $1.5 trillion valuation, that is absolutely enormous. Now, we know that the current pandemic is actually it's the current pandemic has created the perfect situation, a perfect storm for some of these mega cap stocks like Amazon, like Zoom Video. Well, Zoom Video is not exactly a mega cap stock, but it's been a perfect storm for large cap, mega cap tech stocks like Amazon, like Apple, like Microsoft. Are they up too much? Are we relying on just a handful of stocks too much? And if these turn around, what does that mean for the rest of the market? That's what we're going to get into. First, if you're a viewer of the show, you know that I always go through a quick market update. I hope you are enjoying this. And if you have any questions, please ask away in the comments. I'd love to hear from you. I'd love to converse with you. That is, to me, the most fun. And we're going to do this quick update with a share screen. We've got a lot to go over in a short amount of time. So we're going to keep at a pretty fair pace. So keep up with me. Pay attention. Okay, here we go. First and foremost, do you see that? The Dow was down just about 400 points. Listen, we were up 560 points yesterday. So it's still a positive week in that regard. S&P was off 34 points, about 1%. NASDAQ held up a little better, down almost 1%, down about 90 points. And just have to get used to that. NASDAQ, look at that, 10,000 plus on the NASDAQ. Hopefully that'll stick, but I'm not feeling so optimistic about that, but that's my own educational opinion. The Russell 2000 down almost 2%, and the VIX up 5%. The VIX does that. If the major averages are off 1%, the VIX could easily be up 4 or 5%. The VIX basically usually moves in the opposite direction of the major averages, but with the VIX up over 5% today, and that's common. If the major averages move 1 or 2%, the VIX could move 5 or 6%. But that means professional investors, professional traders are a little nervous. They're starting to hedge their positions, and they're probably starting to wonder, hey, we've made so much money, crazy money in stocks. It's probably time to either take some profit or hedge our positions. By the way, hedging could be pretty expensive. Sometimes you're just better off taking some gains, sit in some cash, and wait for a new pitch. Okay, the Dow was down almost 400 today, but if it wasn't for, I don't know if you can see that on your screen. I'm going to make this a little bigger. Hopefully that'll work. There you go. Okay, the Dow was down quite a bit today, but if it wasn't for Walmart being up $8 a share, which is easily the standout performer in the Dow Jones Industrial Average. By the way, the Dow, the S&P, the Nasdaq, the Russell, these are indexes. You can't invest directly into an index, but you could certainly invest in a security that tracks or mimics the index. So let's take a look at that. So Walmart today was up over $8 a share, up almost 7%, because they announced that they're coming out with Walmart Plus, which is going to be, as they describe it, a competitor to Amazon Prime. Moving on, okay? See the headline? Walmart rises 7%, a report of Amazon Prime competitor coming this month. So let's take a look at the FANG M watch list. FANG M, Facebook, Amazon, Apple, Netflix, Alphabet. I know it's a G for Google, but that's what we're going by. Microsoft. So Facebook was up a touch after being down a good chunk of the day. Apple was off a little bit. Amazon was off almost 2% after being up over 5% yesterday, though. Netflix off a touch. Google off a little bit more than 0.5%. Microsoft off over 1%. Microsoft and Apple actually hit New Year highs earlier today, but they could not hold on to them. And there was some news on Facebook after the close. We'll see if we could pull a quote up here. Screen runs a little slower when you're doing the screen share and live streaming. But all right, so Facebook is off a little bit less than $1. They met with the activists and the boycott group to boycott advertising on Facebook, and the boycott group kind of they said they walked away very disappointed with how the meeting went. So that is that one. We're going to take a look at my Corona watch list. Zoom up again, up $1. Clorox up a little bit more. Listen, about 3-4 weeks ago, it was 196, 198, it's 223. Activision 78, but that's up a lot in the last couple of weeks. Peloton hitting 60. Domino's off a little bit, but it's been up a lot. Campbell Soup. Campbell Soup is a pantry stock. You load up on non-perishable goods when you think you're going to have to quarantine. And that's what Campbell Soup represents. And here's the ultimate watch list that I see every day. I look at this throughout the day. I think this is more important than looking at how the S&P is doing at the moment. People look up the Dow, they look up the S&P, and they say, oh, how's the market doing today? I don't think that's the most important thing to look at. My watch list of 11 exchange traded funds, each one represents one of the 11 major sectors of the economy, tells you a lot more. And when you see the only thing that was up really and of any consequence was consumer staples, building materials, just about flat. But what's really bad about today, and we've been seeing this a lot more, is industrials, financials, and energy are at the bottom, the worst performers of the day. We've been seeing that a lot. And that tells you that the economy is not looking so good in the eyes of investors. Investors are expecting the economy to do worse going forward. And, investors are look, we've been talking about this on the show for a while, I've been talking about this last week a lot, as you see the COVID-19 positives increase a lot. And, stay-at-home orders or, the opening phases are being scaled back. The economy, the reopening is either going to slow down or it's going to go in reverse. Not a good thing. And this is something that no one really talks about. So, gosh darn it, I hate when I get a white screen because it takes a second for things to reload. Here we go, Sparky. Okay, let's just pull this down a little bit, okay? Do you know what this is? The green. This is not necessarily a year-to-date chart because I touched the wrong button. So I'm not really sure What time frame? Okay, so look, the point of this though is you can see the underperformance. The green is the S&P. The red, it's a 12. It's a pretty big differential. That is the S&P 500 equal weighting. So right now the S&P is actually off 2.65% year to date, and the S&P equal weight is down 12%. What's the difference? The S&P 500, the top 6 stocks represent just about 30% of that benchmark. So those are the big FANG plus M stocks. It's Facebook, it's Amazon, Alphabet, Netflix, Google, Microsoft, et cetera. Okay, so that, and those stocks, since they're bigger companies, they have a bigger impact on the S&P 500. Not all companies have the same impact on the S&P 500. Bigger companies have a bigger impact. Smaller companies have a smaller impact. It just happens to be that the biggest companies in the S&P 500, it's like this pandemic was tailor-made for these companies, these big companies, because they're screen stocks. They allow you to work from home. They allow you to entertain yourself at home. They allow you to connect with other people at home. So they have done exceptionally well. So they've helped hold up the S&P. But if they were just the same weighting as other stocks in the S&P 500, it would be down 12%. So there's a 10 percentage point gap. That is, not only is that a really big gap, but historically, that's the biggest gap I've ever seen, which just goes to show you how much the S&P 500 index and index investors and active investors, how much everyone is just relying on a handful of stocks to make their returns. I think it could be a dangerous situation, and I'll show you this last chart, and then we're going to talk about the meat of this live stream. We're actually getting through this pretty quick. Hope this chart comes up really fast. Okay, here we are. Tesla hit a new high today, but let me show you this chart. Okay, there we go. Okay, I appreciate your patience here. All right, so the green up here, okay, is it's a little too big for my use. See if I can make that a little bit smaller so we can all see it on the same screen. There we go. Maybe make that even a little smaller. But this is really like the most telling thing that I'm going to show you. This is really important because when you see this, it's going to put everything in perspective. All right. This here is year to date. Okay. Amazon is over here. Over here it says 71%. Zoom 274% year to date. Tesla up 300%. Apple up 44%. It's like only 44%. So that is significant when you see massive outperformance. I'm not even going to bother putting up charts of like United Airlines or Honeywell or 3M or Bank of America, or Merck, because these stocks are just Chevron. They're not doing that great. So it's just a handful of stocks that's lifting everything. So if you look at how much these stocks are up, and I could throw in plenty of other stocks. I could throw in Salesforce.com. I could throw in NVIDIA. These are all the popular stocks. Peloton. I could throw in all these stocks and we could talk about them. And it's nuts. And I don't want to say it's, I don't want to use hyperbole. They're up a lot. It's extraordinary. Okay, we won't use hyperbole. It's nuts. Oh my God. I did it again. So let's talk about this. When you see Amazon up 65% or so year to date and up just about a double from its bottom, you're talking about $500 billion plus moves in individual companies in a matter of months. What do these companies do to become worth that much more? Now, I had a conversation with somebody, a trader, and we're talking about valuation. When you're in the thick of it and stock is doing well, the valuation is like, oh, it makes sense because, these companies are the bridge stocks to the future, or they are the future. They're allowing us to shop. They're allowing us to live and work, at home and to stay at home. I'm not doubting that these are not great businesses. Listen, Warren Buffett called Amazon an economic miracle. You can't dispute that because Amazon has Amazon Web Services, Prime, video. They have plenty of great businesses, and it's exciting to see what else they're going to get into. They just bought a self-driving technology company, Amazon. Okay, so Google is also in that business. Certainly, Tesla is. So here's how you have to look at it. Everyone who has bet against these stocks ever has been wrong over time. I'm not saying that these stocks haven't had dips where investors made money betting on that they would go down and got back in. I'm not saying that people haven't successfully traded these stocks over time, but for over the long term, anyone who said, nah, they're overvalued, Tesla's going to, go out of business, they can't survive, they don't have the economies of scale, Amazon's got, the PE ratio is too high. I've been hearing that the PE ratio on Amazon is too high now for over 20 years. And it's still too high, right? Well, let me tell you, betting against these stocks has been a sucker's game. It's been a losing proposition. So am I going to come out here and tell you that these should be sold and you should take profits? That's not the point of this. The point of this is to say, you have to make up your own mind based on your own personal finance, your own risk tolerance, your time horizon, your goals, that if you are up a lot in any of these stocks, these are the stocks that are making your portfolio, that are making you money now, that are making you happy. If these stocks were to tumble and drop from where they are now, 20, 30, 40% or more, how would you feel? Because like everybody else, you may be leaning on them, or like many others, you may be leaning on them too hard. And if they fell, how would you feel about that? If you're somebody who says, I wouldn't be able to tolerate that, that would be too much, I can't handle it, then in that case, my recommendation for if I was having a conversation with a client around that, I would say we need to either take a little off, sell a little bit, or we need to maybe sell all of it. I don't like all or none decisions, and I'm not saying that you specifically should do that. I'm giving you a hypothetical that says, hey, if these stocks took off and kept going up, and I believe that 3 to 5 years from now, they're going to even be bigger. But at this rate, at the compounding rate of the last 6 months of FANG M stocks, they would probably represent like half of the entire S&P 500 index. It's really just massive. I mean, Amazon and Apple are worth over $1.5 trillion. Now, they have great metrics. They have incredible growth, sales, money. But if they were to just stop growing, for example, just stay where they are, that alone would be enough to knock these stocks down. Because when you do have a high PE ratio or a highly valued stock and a stock that it's at a high, you're expecting more growth. Look, a stock cannot make a new year high, or it can't make a new all-time high. Let me repeat that. A stock cannot make an all-time high without the belief that it's going higher. Otherwise, it wouldn't be at an all-time high. And when I look at some of these stocks, and Tesla's up 40% in the last couple of weeks. It's really remarkable, the valuations in these stocks. I don't think valuation, by the way, is a good timing mechanism, because you're not going to be able to time the top. And maybe if you sold today, you hit the top. Maybe you got lucky. If you did make the top today and you sold, you got lucky. Maybe they keep going higher, and it's really hard to let go of a winner. So what I'm saying is, use your own personal finance as your guide. If giving back a lot of the gains in these stocks would hurt your financial plans, would set you back, would make you very upset, then you could consider taking some off. Now, I have taken some off of these stocks for my clients, not all of my clients, But in my clientele, I've done some of that today. It's because I understand my clients' personal finance. I understand their goals, their risk tolerance. And I said, about a week ago, actually about 2 weeks ago, that I said, I have these stocks up to my eyeballs. I can't buy any more because it's just too much concentration risk. So in the year 2000, Amazon went down something with 95%, something to that effect. Now, I know today you look at Amazon and you say, no, that could never happen. But every now and then you look at fallen angels like IBM, AT&T, ExxonMobil, General Motors. These stocks all had their day. Apple almost went out of business twice until they finally came out with the iPod and then the iPhone, and it was just a whole new ballgame for them. So the bottom line, recalibrate or review how you feel about these stocks. And if these stocks give back a lot and you would be negatively impacted, given that you have so much in profit in these companies, then I think in your case, if that is your case, hypothetically, then it would make sense to take some off. It's like making money anywhere else. Sometimes you could just walk away from the table, keep the money. And if you've made, a double in these stocks, and I'm not saying a double over many years, some of these stocks have doubled and more in a very short amount of time, you could walk away happy and nobody could blame you. So that's my take on this. The rest of it really has to be up to you. Now, if you'd like to give me a call and discuss your personal financial situation in determining whether or not you should be selling some of these stocks or making other changes with regard to your investments, you are certainly welcome to call. The phone number is in the scroll below. You see that going at the bottom of the screen. Definitely give me a call. I'm going to end the broadcast now. I thank you for watching. I got a heart from Judy. Thank you, Judy. Love you too. And I'll see everyone tomorrow. Thank you so much. I really appreciate your taking the time to watch.